What's up, everybody? Tara Stoneworks Real Estate. I'm here with my favorite local lender, Michael Sullivan, owner of Capital M Lending, and we're going to talk to you a little bit about the market today and some tips on how to save money on your current mortgage payment.
Absolutely, yeah.
Did I say that right?
I think you did.
Okay.
Yeah, I think you did really well.
All right.
Let's be honest. If you guys have a mortgage from one of us that's been in the business for a while, you're rocking some 2 or 3% interest rate.
You're like, why are you talking to me?
Seriously, yeah. We're not getting rid of that mortgage at all. That's not what this is about. But I am noticing that even though values have been fluctuating a little bit, a lot of people that got into these 2%, 3% interest rates, I mean, they had mortgage insurance, and it's time to get out of it. Or it might be time to get out of it.
Yeah, and mortgage insurance, if you don't know the link, it's PMI is what it's typically called. So you'll see that, you saw it on the closing statement, and it's on there. And what's like the average that people would pay for PMI, like monthly?
Well, I mean, it's tied to the loan amount, but it easily can be at $100. It can easily be at a couple $100. You know, and I want to be specific. We're talking about conventional loans.
Yes.
If you have an FHA loan, you're not getting rid of the PMI or the private mortgage insurance. So this is really more about Fannie, Freddie loans, conventional loans.
Okay.
Yeah.
Well, thanks for the note.
Need to be clear on that. Need to be clear.
So basically, the private mortgage insurance is there as an additional way to kind of deal with the risk associated if you don't put 20% down on your loan. So if you do, 5%, 10%, whatever, you're kind of covering, the bank's basically covering their butts by adding that on.
Correct. It's just a way of opening up the market so that you don't have to put 20% down. I think way back when, even before my 30 years, it was sort of like you had to put 20% down or nobody wanted to give you a loan.
Yeah,
and
that's when houses only cost like $80,000.
Or 12, but 12,000. But yeah, so now really what's happened for decades, of course, is allowing private mortgage insurance to make up that difference. Meaning, hey, if you're going to buy a house for less than 20, we'll make you pay this mortgage insurance policy. It protects the lender against you for not paying your mortgage insurance. So it's a necessary item and is better to pay monthly mortgage insurance than wait until you have 20% down.
Yeah.
But the key is that if you can, we want to get you out of it.
Yeah. I think that's sort of a thing, like a lot of people, and maybe your lender is or is not talking with you about that. Like, hey, when you hit equity or you've paid it down enough to be out of that, you can actually get it removed. We'll talk about a couple of ways of doing that. But I mean, if you can save $100 to $300, $400 a month right now, that's amazing. Especially if you're like, you just need the extra cash for groceries or whatever.
Well, and especially if you're in one of those mortgages where the interest rate's so low that you don't want to, because a lot of times in the past when rates didn't have such a fluctuation, when it was time to get out of the mortgage insurance, you just refinanced.
Yeah.
Well, I'm not going to refinance any of my clients at a 2 or 3% interest rate. I mean, that's crazy talk.
That's not why we're here.
I don't want to do that. I want to keep you in that awesome rate until it's really, truly time to move out of that house.
Yeah.
So when you buy a house with less than 20% down, this process of getting out of the mortgage insurance, there's kind of 2 ways. The first way is what we call dummy proof, and it's going to happen automatically. And that is where you think about the value or the appraised value that you had at the time of purchase. You put your down payment in, and then you make your mortgage payment so the loan amount's going to, you make your mortgage payment so the loan amount goes down and down. And then when you have 22% equity position, so different from purchase. Purchase, 20% down, no PMI. If you buy a house with less than 20%, you need to pay it down to a 22% equity position or have a 78% loan to value, depending on how you're looking at it.
I think isn't the average like 5 to 6 years for people typically to do that?
I actually say more like 8 years.
Okay.
Yeah.
8 years.
Until you get to that natural place where the lender just goes, hey, by the way, you're out of mortgage insurance.
Yeah.
And so it's really nice when you get there. But with values increasing, so you've purchased here and now your value is increasing, you can create that equity position sooner by what I think we're going to talk about.
Yep.
And that's that way of getting out of it before you've hit that 22% equity position based on the price you paid.
So I'll tell you a personal story. Back in 2021, so rates were still really good. My husband and I bought a property, and within 15 calendar months, I think we put 10% down or something. Within 15 calendar months, we'd paid down enough, but the equity of the house had gone up so much, we actually called the bank and said, hey, we've met this 22%. So can you get rid of our PMI? And they're like, well, usually, you have to wait a certain amount of time, but you can pay $150. We'll either have it appraised or have a broker come out to do a broker price opinion. So we did that. It took a few weeks, and we ended up saving $250 a month on that payment within the 15 months.
Which is amazing.
Yeah.
That's amazing, because the standard usually is that you have to make mortgage payments on time for at least 2 years.
Yep.
And so it's nice that they let you out so soon.
Yeah.
But that's really the process, is calling them and discussing with them their policy and way of getting out of mortgage insurance. Now, no lender can make their own policy less attractive for you, meaning that there are rules from the CFPB about how to get out of mortgage insurance. That first one we talked about, you've just gotten to a point where you have 22% equity based on the purchase that you paid for, the price or the value of the house when you got the loan. But after that, the lenders will have this process, and as long as you're communicating with them and going through their process, they have to honor this request to look at the private mortgage insurance. So there's a couple things, though, that you have to have in place to get out of it. So on-time payments, obviously very important. No junior liens. So if you have like a home equity line or something like that, you're probably not going to get out of the private mortgage insurance through this process. So you might have to get rid of that in order to get rid of the PMI.
Yeah.
The CFPB,
that I didn't know, actually.
Yeah, so. Yeah. The CFPB will tell you that you have to make this request in writing for at least them to honor it. Most of the time you can call and these lenders will honor it.
No, you guys know what a fax machine is?
No, what's a fax machine? Who uses fax now?
Some people do. I'm let me go
we
back
have
to the
fax.
90s.
We have a fax for our business because some people need it.
So
but,
call Michael. He'll hook you up.
Yeah, exactly.
With all your faxing needs. I think we did ours in like an email. Yeah. So in writing that way, or you can write a letter or something.
Something, yeah.
Or a fax.
Yeah, or a fax, yeah. But yeah, you make this request and you pay a certain dollar amount, and then they'll have someone come out and appraise your home. And just like you said earlier, it could be an appraisal, which might be a few $100s. It could be less cost if it's a broker valuation. But one way or another, this lender needs to get, hey, what's the current value?
Yep.
And if the current value is here and you've made all your payments on time and don't have the second mortgage or a junior lien, and all of a sudden we realize that you've got that equity position, then you get to drop this mortgage insurance. And I think there's going to be a lot of people that are going to benefit from getting out of mortgage insurance, because there's always this desire to get out of it. Mm-hmm. And again, in a normal market, you just refinance out of it and it's easy.
Right.
We don't have to be at the whims of this lender or your payment history.
Normal market.
Yeah, normal market. This is not a normal market. But, in today's world, when so many, at least of my clients, are sitting with, 2 and 3% 30-year fixed interest rates, we don't want to touch that. No. And if we can save the $60 or the couple $100 by giving you this advice to go through and getting rid of the mortgage insurance, it's huge. It's so nice to then be able to keep that mortgage, have that low payment, and just still be in a really great place.
Yeah, I mean, and the thought that kind of comes to my mind is, say you do need to buy and move for whatever reason, qualifying life events, there's a lot of stuff that happens. You're going to rent your primary residence out. You've been in it for 2 years. You get that PMI off, and you're going to go and look for another property. I mean, that would lower your debt to income also.
Lower your debt to income ratio, allow the property to potentially cash flow as a rental. I mean, there's a lot of reasons that you'll want to get rid of PMI.
Yeah.
For sure.
Well, and if you don't need it, wait.
Yeah, seriously. Cut it.
All right, well, hopefully this video was helpful to you. I'll link Michael's information down below. And if you're just in the market, even if you haven't bought a home before, there's creative ways to kind of get into different things. We'll make another video about that. But yeah, let me know if you have any questions. Thanks, Michael, for doing the video today.
Yeah, you
All
bet.
right.
Hope this helps.
Peace till next time.
Take care.
Crushed. This is why I like to do videos.